Hello, my friends. Today is July 15th. My name is Joseph, and this is Markets Weekly. This week was an exciting week in markets, so we have a lot to talk about. First, last week I was thinking the top was in the risk asset markets, and I was 1000% wrong, and the market still looks like it wants to go higher. Now, this is a point of concern that I've been talking about for some time, and we'll talk about it throughout this session. But first, as usual, we're going to talk about three things. First, we're going to talk about the big news of the week, the CPI data. Is inflation dead? Are we going back to pre-2020 levels? Does that mean that the Fed is going to cut rates very soon? Secondly, we got to talk about what's happening in Japan, because if you look at the yen and the Japanese bond market, it looks like more and more people are anticipating a change in yield curve control. And lastly, we have to talk about a debate that's happening within the Fed right now, and that is whether or not monetary policy really acts with long and variable lags. Because if it doesn't, well, then we got to keep hiking rates. Okay, starting with inflation. So at the beginning of this week, the 10-year was above 4%, risk assets were, digesting a bit, and then boom. We had a CPI report that was softer than expected, both in headline and in core. And it was notably softer, such that many people were looking at this and saying that, inflation is over. If you were looking at social media, you would have noticed that many people who initially said that inflation was transitory basically jumped out and began doing their victory dance. And of course, as we all remember, back then they were saying that inflation was transitory, so the Fed doesn't need to hike rates. In fact, inflation was not transitory, and the Fed hiked rates by 500 basis points, and inflation is still here. So those guys are still totally, completely wrong. That being said, is inflation actually over? Did the Fed perform a quote-unquote soft landing where, inflation was really high, now it's calmed down, back to 2%. Are we going to smoothly sail at this 2% rate for the foreseeable future? The world goes back to how it was before 2020, and then everything is okay. The economy continues to grow. And of course, soon the Fed will have to cut rates because with inflation at 2%, we don't need the Fed funds rate at 5%, right? And so the market saw that and began to rally. Remember, one of the biggest determinants of risk assets is the stance of policy. Back for the past few months, everyone was thinking recession, Fed cuts rates, so you got to buy risk assets. Now it's inflation is over, Fed's going to cut rates, so you got to buy risk assets. And you know what? It's possible that inflation really could be tamed. That's a possibility. So if you follow me for any length of time, that's not really how I think about it. So I would actually, before we go further, I would actually point to a few other things that we have to keep in mind. Well, first, recall just a few episodes ago, we talked about what happened in Canada and in Australia. In those two countries, they got some good inflation prints. The central banks stood up, patted themselves on the back, and announced a pause. And then within a couple months, they began to see that actually inflation seemed to be reaccelerating. What they were looking at was really a false dawn. And so they began to start hiking again. And indeed, the Bank of Canada, who declared victory in January only to hike again last month, hiked again this past week. Even looking at the US itself, you can remember a couple summers ago that the US had inflation that seemed to be going away only to see it surge higher. So we could be seeing a false dawn. It's not really clear yet. We need to have more data. Now, here's an interesting fact from the 1970s and 80s. Here, this is a chart of inflation back then. And you'll notice that inflation rocketed up strongly like a rocket ship. Then, after climbing Mount Everest, it seemed to tumble down precipitously. And at that point, you can imagine when inflation was tumbling down like that maybe that it was over. Maybe that the Fed could have at that time cut rates and then we would have back to normal. But instead, as you can see from the chart, inflation did not stay low, but began to turn around and rocket higher again, such that it looked like two mountains next to each other rather than a mountain and a flat line. Now, the question on everyone's mind after the CPI print is inflation dead, or is this a false dawn as it was for the Bank of Canada, Bank of Australia, and for the US in recent history and in history long ago? It's not easy to know at this moment. Again, if you follow me, you know that I believe that there are structural reasons where inflation will continue to rise. First off, of course, we have significant deficit spending that continues to create demand. And of course, from the supply side, we have an aging workforce. So every day, boomers are retiring, and we're going to need more people to do all that work. And that's going to keep wages high, which means that people can continue to buy stuff and, afford higher prices. So even if inflation were to come down a bit, if you have wage growth continuing because of a shortage in labor, then that just means that growth will accelerate, which of course is supportive of inflation. So far, it's not super clear which of these scenarios would play out. The market, though, seems very, very much willing to believe that inflation is over. So you can see that the 10-year yield went down a lot after the CPI print, and of course, stock market went up higher. There are many people thinking that, this is a new bull market. We did the soft landing. Everything is going to be okay. Got to buy risk assets because the Fed is going to cut soon. I personally am very cautious on that. Now, secondly, let's talk about what's happening in Japan. So if you look closely at what's happening in the big Japanese asset markets, so you see the Nikkei, basically, at least not rocketing higher, seemingly just meandering about. You see the yen strengthening significantly against the dollar, now below USD GPI below 140, and you also see the 10-year JGB move higher towards the upper bound of yield curve control, which is 0.5%. Now, all of this, taking into account, suggests that there is probably some change in monetary policy. Now, there are reports suggesting that the Bank of Japan might finally been toggling their yield control framework. So as you recall, we've talked about this before, Japan has an inflation target of about 2%, which they've been missing terribly for a very, very, very long time. But recently, inflation in Japan seems to be making a comeback. In fact, it's higher than their target. Now, we've heard clips from new governor of the Bank of Japan, Ueda, suggesting that, our forecasts are that even though inflation is above target now, it's going to come down soon. And if it doesn't come down, then maybe we'll adjust our stance of monetary policy. So in the whole world, even as the Western countries, even as Europe and North America continue to hike rates and have this big inflation problem, Bank of Japan actually hasn't changed their monetary policy stance at all. So there's been a lot of speculation as to whether or not they'll finally do it. That speculation is playing out in the markets right now. Now, I don't know if this is going to happen or not, but if it does, I think it's going to be a shock to the financial system. So if the Bank of Japan were to become more, restrictive, adjust their yield curve control framework, maybe away from 5% being a ceiling for the 10-year JGB yields to maybe 1% being a ceiling, you can expect that to reverberate throughout the global bond markets. Now, global bond markets are, if you look at any graph, you'll see that they're tightly connected. This is because investors are global. If you are an investor in Japan and you don't like seeing, let's say, 0.4% yield on the 10-year, there, maybe you move your money to somewhere else. And so because investors are mobile, they're comparing returns across different jurisdictions. And because of that, global bond markets tend to move together. So if the Bank of Japan were to be more hawkish, that would impact global bond yields and possibly spill over to global risk assets as well. You're seeing the Nikkei kind of chomp around a little bit, you could easily see that being a headwind for other risk assets as well. Now, we'll have to wait and see. So it's going to be definitely something we want to watch for this month. And if not this month, there are other meetings. The belief is that eventually it'll have to happen. It's just not really sure when it will happen. Now, the last thing we'll talk about today is whether or not monetary policy acts with long and variable lags. And let me tell you why this is important. So there's a big debate in the Fed today as to whether or not they should continue to hike. Now, if you are a dove at the Fed, so you don't want the Fed to hike, and what you'll say as your reason is that monetary policy acts with long and variable lags, so a lot of the tightening that we've done over the past year actually hasn't been felt in the economy yet. Now, if you are a hawk, you want to hike rates, and you'll just say that actually, we did a whole bunch of tightening and it's mostly been felt. So our monetary policy tightening is not going to be slowing the economy down anymore, and the economy is still going strong. So if we want to have additional constraints on economic activity, we need to continue to hike. Now, traditionally, the dogma is, the received wisdom from the central banking community is that there are quote unquote long and variable lags to policy. Let's say your hike rates today, and maybe, that effect might not be felt, maybe not till 12 months, maybe 16 months, maybe 2 years since the initial decision. Now, I find that to be really suspect because the more time that elapses between when you do something and when something actually happens, the less you can attribute a cause between the two. So if I bang on a table and the table immediately cracks, well, I can say very clearly that, cause and effect, I banged on the table and it cracked. If I bang on the table and maybe 5 hours later it cracked, well, I think it's a lot less clear if what I did caused the crack. A lot of time in between means that a lot of other factors were playing in as well. So it's more difficult to lash into that cause. So that's one part. Now, the other part is that, so if you are a dove, you're going to point towards this literature of received wisdom and says, long and variable lags, stop. Now, the hawks have a much more interesting argument. And I think it's worth thinking about because Governor Waller just talked about it in a speech this Friday. And his argument for shorter lags to monetary policy are twofold. First is that markets today anticipate the Fed a lot more than markets in the past. Now, in the past, we had Fed chairmen like Alan Greenspan who would actually hike rates and not tell you about it. So, and there were no press conferences. There weren't very many speeches. So you don't really know what the Fed was thinking. So what would happen is that, the Fed would do something, and then you would have all these people kind of look at interest rates to kind of guess to see whether or not the Fed did something. And many people would find out after the fact. That's very different from how central banks operate today. Today, the Fed gives a whole bunch of speeches, press conferences, writings, and so forth. So they're very transparent. So when although the Fed first hiked rates early last year, the market was anticipating that the Fed would do so months in advance. So before the Fed actually does its first rate hike, a lot of that is already priced into the markets. So in a sense, monetary policy is having an impact on the economy even before the Fed actually does anything. And you can see that in the 2-year yield, which began to rise months ahead of the actual rate hike last year. So because of this, lags are logically shorter, right? The way that monetary policy is conducted is very different from the past. And this makes complete sense to me. The second argument that Governor Waller gives is that, when you're hiking big, there's going to be less of a lag than when you're hiking small. So for example, if you're hiking, let's say 25 basis points, and that makes your mortgage rate go up a little bit, that's not really going to affect behavior that much. So someone looks at their mortgage and says, that's okay, Fed hiked rates. So instead of, let's say 4.2%, my mortgage is 4.3%, whatever. But because the Fed hiked rates so aggressively from like 0 to 500 basis points, that same person is looking at this and saying, oh my gosh, I have a 7% mortgage rate. That's definitely going to get my attention and change my behavior. So from that perspective, bigger rates hikes catch the attention of the public more easily and thus more directly impact their behavior. And that makes sense to me as well. So according to him, and from my read, Chairman Powell is also in agreement with this view of the world. They think that a lot of the rate hikes have already filtered through to the economy. So if you want to continue to slow the economy down, you'll need more hikes. And Governor Waller continues to pencil in 2 hikes for the rest of the year. Although he notes that if we continue to get soft CPI prints, maybe we only need 1. By the way, it's totally 100% sure that the Fed will hike in July. That's pretty much baked into the cake. Right now, we're heading into what's called the blackout period, so no more Fed speakers, and they left it at the assumption that the Fed will be hiking rates in July, so that should be done. Now, going forward, what we'll have to see is CPI data and how this debate about long and variable lags continues to evolve in the FOMC. So far, of course, the default is we get more hikes, and if it does turn out that CPI continues to be weak, I think will probably be the end of the hiking cycle in July. Again, we're going to have to see the data, and the Fed will hold here for the next several months. But again, that's something we'll have to see. Although, of course, the market is already very ebullient and assuming that inflation is over. Okay, if it is over, the market is totally right. If it's not, I think you have a real chance of what appears to be a mania unraveling rather quickly. Okay, so that's all I've prepared for today. Thanks so much for tuning in. If you like what I'm producing, remember to like and subscribe. And if you're interested in hearing more about my more in-depth thoughts about the markets and the financial system, check out my blog, fedguy.com. And if you're interested in learning more about how to understand the markets, I recommend my course, Central Banking 101. Markets 101 at centralbanking101.com, which is a series of courses on how to understand markets, and the same course that I would teach our new traders at the Fed's trading desk. All right. Thanks so much. Talk to you guys next week.